Welcome to Oregon Cash Flow Pro. My name is James Barber, as always, here to help you maximize your cash flow. Today is our IUL day. We have an IUL policy that somebody sent in that we're going to do a review on. If you have a policy or an illustration that you would like us to review, send it in. The information you can send it to, I think it's scrolling along the bottom here. You can email it to me. You can sign up for a Zoom meeting with me using that Calendly link that's just down below as well. And we can go over it one-on-one if you'd like to have an individual consult. If you're okay sharing it with everybody like I'm going to do today, send it to me. I'll redact the sensitive information and we'll take a look at it. So illustrations or policies. Tuesdays we do IULs. Thursdays we're doing whole lives. So let's take a look at today's IUL policy that we're going to be reviewing. So this is a National Life policy. We'll start at the top, but we're not going to go through all of this. We're just going to go through the illustration that's attached with it. We're going to take a look at the design and see how it looks. So we can see there's a face amount of $600,000 death benefit, and they have a rider for additional protection benefit of $50,000. I'm wondering right off the bat why they set it up this way. We're going to take a look down below, see if we can figure this out. So we've got an initial premium going in of $37,994. Face amount $60,000, additional protection benefit $50,000. If you haven't seen my National Life video where I go over specific design and how we do a blended design, I'm going to put a link to that when I redo this live stream into a regular video. I'm going to put a link to that up here so you can check it out. But essentially, this additional protection benefit is what we blend in to increase the MEC limit without increasing the commissions. National Life allows us to do a 3-to-1 blend. So ideally, what I would like to see is if we have a $600,000 death benefit, we would see, well, in this case, $650,000. So we would take $650,000, divide that by 4, because I'm not going to do that in my head right now. We're going to go $650,000 divided by 4. So $162,500 should be the face amount. And the additional protection benefit should be 3 times that much. The additional protection benefit should be $487,500. This would give you the lowest target premium, the lowest commissions. Your costs are going to be the lowest. And ultimately, your surrender charges will be lower and your cash value will be higher. Okay? There's no reason not to do the maximum blend that you can if your best interest is the client. Let's see what we can find out here. One of the nice things about National Life, you get the living benefit riders, terminal illness, chronic illness, critical illness, or critical injury. So you've got 4 different ones to choose from in the event that you might need and qualify for some of those things. So what they do, they accelerate the death benefit before you actually die. So one of the appealing things about the National Life IUL is they're the only one that offers 4 different living benefit riders like that. They're like pseudo long-term care riders. It's not long-term care. It has not quite the same amount of coverage that you would get there on a long-term care. And it does come from the actual death benefit if you end up utilizing those. Here, current interest bonus for each crediting strategy. So the Credit Suisse has the best bonus at 0.9. What else? Yeah, so this policy was put in force before the current indexes. Right now, there's 2 volatility indexes. One is the Credit Suisse, and they reduced the bonus on the Credit Suisse. They increased the bonus on the the newer one. Can't recall off the top of my head the name of it. It starts with a B. The new one. Not relevant for this one, so we're going to move on. Okay, here's our MEC limit. Our MEC limit 37,994, and that is what he's putting in the first year. This is a male preferred non-tobacco rating. So we have the right amount of death benefit for the amount of money that they're putting in. It's not the right split, in my opinion. So this will have a higher commission associated with it. But let's see what that does for impacting the cash values. Now, our max non-MEC premium, when this number is higher than this number, you're using the guideline premium test for your MEC testing. They will allow you to put in up to the max non-MEC for the first 2 or 3 or 4 years. But then the amount you're going to be able to put in is going to drop down, because by year 5, your average has to be this number or lower for each year in the policy. And this is the long-term MEC limit. So this comes into effect at the beginning of your policy. So you can contribute this, but just know that it's going to be, you're contributing the very maximum, then it's going to drop down, then it'll come back up so that you can contribute the 37,994 for the rest of the life of the policy. Well, through age 99. Okay, unless you make some type of a change in it and the MEC limits get recalculated. If the max non-MEC happens to be a lower number than the guideline level premium, this is going to dictate the MEC limit for the first 7 years of the policy, and then it will revert to the guideline level premium. Now, if you're using the cash value accumulation test for your MEC limit, then it's just the max non-MEC. That's the only one that's used for that. We generally use the guideline premium test because you're required to carry less death benefit throughout the life of the policy. And when we get older and that cost of insurance goes up, that's when we want to be able to reduce the death benefit. So we can reduce our costs more in older age by a lot by using the guideline premium test as opposed to the max non-MEC. So that's why we use that one. All right, we have a minimum premium here, $5,900. Target premium. Those of you following my channel, watching my videos, you remember target premium essentially tells you how much commission gets paid out. The agent on the street generally makes 100% of target premium as their first year commission. After that, it's going to be a small recurring amount. Now, not everybody makes 100%. In fact, I don't get 100% of target premium with National Life because of the contract that I originally signed. I think I get like 85% of target premium. Some agents that join multi-level marketing organizations, they may get 25% of target premium. But the bottom line is the target premium is what determines the commission, not necessarily the agent. That's not necessarily what they're going to get, but the people that's in line with them, so they're upline. In the case of the agent that's getting 25% of target premium, somebody that recruited them is getting more than that, is getting the remainder of what's available to pay out. And then you have the marketing organizations that help agents contract with the carriers. They get an override also. And all of those numbers are based on target premium. So the higher that target premium, the higher your costs are going to be because it's compensating the agent and everybody in the insurance company at a much higher rate than when we have a lower target premium. Okay. So this is a high target premium in relation to what you could get with an optimum design. Now, if you watch my part 4 of my IUL series, and I'll link that up here later on too. If you watch my part 4, I show you 4 different designs. One that you pay a high commission up front, one that you don't manage it in the future to reduce the expenses, one that you pay a low commission up front and you don't manage it in the future, one that you pay a low commission up front that you don't manage in the future, and one that you pay a low commission up front and you do manage it. I think I messed up that second one. The second one was, high commission don't manage it, don't manage the expenses. Low commission, don't manage the expenses. High commission, manage the expenses. Low commission, manage the expenses. So we have what I call the high high, the low high, the high low, and the low low. Those are the four different designs. Okay. The best performing is obviously you pay the lowest commission and you manage it for lower expenses. That's our low low. The second best design long term, so like if you live to like age 90, the second best is going to be paying the higher commissions but managing your expenses in the future. So it ends up being more important to manage your expenses in these policies in the future. Just because you paid a high commission doesn't mean you have the worst product out there and you got to figure out how to get rid of it. Okay? It's not the most terrible thing in the world. It just could have been better. And if you know to do better, hopefully you will demand better the next time you buy one of these, or if you have friends or family that's looking to buy one of these, or if you're an agent and you're looking to sell one of these, I hope you're doing what's best for your clients. Malik, how's it going? Gil, hey, good morning or good afternoon. Okay, so this is a high commission design. It barely added in any additional protection benefit in order to reduce the commission. So the commission could have been slightly higher if they didn't do the 50,000 here as additional protection benefit, but not much difference. This is still a high commission design. If this was an optimized design, that commission probably would have been closer to 2,500 would be my guess. Probably right around 2,500. Okay. The impact of that is lower surrender charges. So you have more cash value available to you out of the gate. Now, National Life does not let you borrow in the first year from your policy. So when we're going to get to the numbers of these, it doesn't matter. It doesn't matter what the cash value is in year one. It matters what the cash value is in year two, because that if you want access to it. Now, it matters in the sense that it's a reflection of how much your expenses are in the policy and how your policy was designed. And that's really what we're most concerned with. One of the nice things about National Life, you get the systematic allocation rider. That allows you to basically dollar cost average over the course of each month throughout the year. So you have 12 point-to-points. So it's like a monthly dollar cost average as your money goes into your policy. Balance sheet benefit rider. Did they include that? They did. They included the balance sheet benefit rider. That does away with the surrender charges. So that's one of the tricks that agents can use to fool you into thinking you got a better design policy, because there should be no surrender charges that show up. So you're going to have more cash value available in year one, not because they reduced their commission and the surrender charges were minimized, but because you're paying extra for that. In this case, that balance sheet benefit rider, it costs them almost $35 a month. $35 a month. This client is paying, and I don't know if they realize this because I don't know the conversation they had with their client or with their agent, but they're paying extra to have access to all of the cash value. Okay. You still can't take a loan in the first year, but if you were to cancel your policy, you would get all your money back because there's no surrender charges. So there can be some value in that, especially if you have a high commission design, but you need to realize that when you see the cash value in this in year one, it's not because it was a reduced commission design. You're actually paying more for this. Now, in this case, this might be a premium financing case. And so they could have used that balance sheet benefit rider in order to make it so that this client doesn't have to come up with as much collateral. Okay. It mentioned earlier on in here. Let me go back up real quick. I'll show you why I think that might be the case. So back up here. I didn't quite make it to the top. right here, premium information, and it says loan/premium finance. So my thinking is that this person is getting a premium finance policies. Most agents that sell premium finance policies, they don't give you a reduced commission design. It's generally a higher death benefit. They make a lot of money on those policies in general. Okay. This is a lower premium finance policy since it's only a $600,000 death benefit. I've seen some that are like $50 million in death benefit, and the agent's making a couple $100,000 in commission. Sometimes they can even make more than that. Just depends. But that's not a reduced commission design either. When I illustrated those exact same designs, I could do it was like a $10,000 commission or a $20,000 commission as opposed to a $100,000 or $200,000 commission. It's crazy when you don't know, and the amount of costs that get built into some of these things. And one of the ways that they kind of hide that is by using that balance sheet benefit rider. When people are doing premium financing, and premium financing is not so attractive these days because the interest rates went up. But when people are doing premium financing, they're generally looking to leverage, get a loan from a bank or a lender in order to fund these policies. Generally, we look to do that at a very low interest rate and get some type of arbitrage. Sometimes it might be just so that they don't have to maybe sell stocks or equity in a business in order to get cash to fund a policy, but they need a policy and they need that death benefit. Sometimes the death benefit is the goal in those cases, but you're still going to be better off in every instance if you get a reduced commission design. Okay, let's get back to where we were. So balance sheet benefit rider, keep an eye out for that. In the case of premium financing, it does allow you to have reduced collateral, but a reduced commission design also reduces the collateral. And ultimately, you can do both of those if you want to or need to. So just because we do a reduced commission design doesn't mean you can't use that balance sheet benefit rider. The balance sheet benefit rider actually costs a lot less if you use that in conjunction with a reduced commission design. Now, here's our accumulated value. This is our guaranteed values. We don't care about the guaranteed values too much here. Here's our illustrated values. So put in 37,000. They got 33,770 in accumulated value in year one. And the cash surrender value is the exact same. That's because of that balance sheet benefit rider. Again, people see this. Clients that don't know better see this and they go, oh, I got cash value in year one. This must be a good design. And it looks fairly attractive. By year 10, there's 447,000 in here, more money than was paid into it. But how many years did it take to break even? It actually took 8 to 9 years to break even on this policy. Yeah, 8 to 9 years to break even on this policy. That's longer than we would like to see. This is also assuming current illustrated values. 5.73 is the rate that's being assumed. Now, National Life's bonus kicks in after year 6. So after year 6, it goes from a 5.73 assumption up to 6.63 is the assumed rate from year 6 on inside this policy. So here's our growth, 6.63 beginning in year 6. Prior to that, 5.73. Not bad though. You know, the goal is down the road, they've got cash value more than they otherwise would have had. So in this situation, I don't know what the plan is, how much he has to kick in and how much is coming from the bank. Let's assume all of it. No, all of it's not coming from the bank because it pays off the loan right here in year 15. This is the premium finance loan getting paid off. So if this has grown to 416,000 over 15 years, this was not 100% financed. Oftentimes what you'll see is like half of it gets paid for the first 5 years by the client and the other half gets paid by the bank. And then in the last 5 years, all of it gets paid by the bank. in which case we are at 37,994 divided by 2. So almost 19,000 gets paid by the bank in the first 5 years. So times 5, that brings us up to almost 100,000 and 95,000, and then 37,994 for the next 5 years. That's another 189. So you got about 300,000, less than 300,000 that the bank kicked in, and in year 15, you got to pay a loan off of 416. Okay, so this client kicked in 19,000 a year for 5 years, most likely, and hopefully they'll chime in here and let us know if the assumptions being made are correct. They kicked in 95,000. At the end of this time, when they pay off this loan, the cash surrender value is 162,000. That's a little bit better. I have a feeling that a properly designed policy, if they were just putting in 19,000 a year themselves, we probably could have had the same design and they have about the same amount of money without borrowing from the bank and taking on that risk. The numbers would likely be fairly similar in any regard. Okay, that's my guess. So hopefully this person sees this and lets me know if we're making any type of valid assumptions here. The benefit usually, though, remember, is you get a much higher death benefit throughout that time. Now it's going to pay off the loan. If you pass away, it'll pay off that loan. So the net death benefit is not a whole lot, but generally the net death benefit is more than what you otherwise would have had. Okay, there's all kinds of different ways to do premium financing. This is one of the ways. There's other ways where you don't contribute half, you contribute 10% or 20%, for a number of years. So I need to know from this person what their actual plan was in order to assess how I feel about this. I'm also interested in knowing how their loan is doing currently, because premium financing has gotten in trouble with the rising interest rate environment. Like, you might have started out with a 2 to 3% loan rate a couple of years ago, and now it's up over 6%. Well, you could borrow from the insurance company, in this case National Life, at less than 5%. So it might be, if there's no prepayment penalties, some premium finance people are shifting those loans back to the insurance company. But if you're relying on the bank, on that lender to finance these, you can't do that. Okay. So it all depends on what your plan is with the premium finance company. This also was the original illustration. I don't even think at 2%, if it was a 2% interest rate, which was like around the lowest that they were offering at one point, I don't think this is 100% financed. They've got to kick in something here. And generally, their collateral requirement is the difference between the premium outlay and the actual cash value. So if the cash value doesn't grow the way that you expect it to, or the interest goes up higher on the loan, your collateral is going to increase. So there's definitely some risks to know about when it comes to premium finance. In this scenario, they're also projecting that this person can pull out an income of $38,000 a year beginning at retirement. So this is likely the appeal of why they got into this. If they're putting in $19,000 for 5 years, and then when they get to retirement, they get to pull out $38,000 a year until age 90, from 65 to 90, so 25 years of that. That's a pretty attractive proposition. Now, it could be better if we do a reduced commission design, and there are risks involved in this. Okay, National Life, what type of loan? I'm interested. This one doesn't tell me what type of loans they're assuming. Current illustrated rate credited to loan values will never be greater than 0.5%. So I think they're using the participating index loans, which you're not likely to do this. We've gone over this a number of times in our recent videos. You're not likely to do that amount of withdrawal with a participating index loan every year in retirement, because it gets very risky. You can see over here, at this point, you've got $1 million in loans out at age 81. And there's only $130,000 in cash value. Your loan interest that year is going to be $50,000. So if you get a zero credit for that year, if you're not making any money because the market's down, suddenly this drops in half. And you go to pull out 38,000 again, and then there's another 0 year, suddenly your policy is at risk of lapse. Okay, so these can get risky. I would prefer to see a projected income based on the fixed wash loans in this case, at least after a few years. And of course, there's also the added risk that we've got premium financing in here, which pays off this loan right here. So there's definitely some risks and concerns with this policy that you need to be aware of. So hopefully this client was properly educated by the agent before they bought it as to those risks. If they have the income to mitigate some of these risks before it gets to this point, they might want to consider that. That might mean paying off some of this loan if they have the ability to. So not relying maybe on the finance company for the remainder of some of these loans, if they're able to do that. Once they pay off that loan, if their income has grown, because they've got 20 years here where their income could have expanded before they're ready for retirement, if they have the ability to pay down some of those loans, it's going to make this a much safer place to withdraw this income in retirement. So those are things that I would consider and think about doing in order to mitigate some of these risks. Now, if they end up, let's say that his income is doing awesome and he's able to pay back all 400,000 of these loans, he's going to be able to take a lot more potential income in retirement than this projection of 38,000, because this projection of 38,000 never paid back that $400,000 loan. Now it did, in this assumption, it did assume that you're getting arbitrage every year on that loan as well. So you want to make sure that the indexes that you're using are returning a positive arbitrage. In this case, it's assuming 0.5%. If you're getting 0.5% or higher arbitrage, this plan looks a lot safer. It is possible that that can happen, but you got to be aware of these things so you can monitor it, and you're not going to end up with any surprises when you get into retirement. So a bit of complication, or I should say it gets a bit complicated when you've got to start thinking about all of these things. But that's why we're putting this out on video, so you can rewatch it, listen to it again, remind yourself, maybe take some notes, have them on your policy, check this stuff, be aware of these risks. That's the value of watching these videos and seeing us go through this here on YouTube. Otherwise, if you just meet with an agent in person, if you just meet with your agent in person and you make this discussion, you're not going to remember this stuff. You're not going to remember half the stuff you talk about. There's a lot of value in getting this stuff out on video. So I'm going to remind you again, if you have a policy that you're interested in me reviewing, that you can then save the video and keep that for future use, send it in. My email is james@OregonCashflowPro.com. You can email it to me. You can sign up on my Calendly at calendly.com/cashflowpro. You can sign up for a meeting with me. We can go over it one-on-one. When we meet one-on-one, you also get a copy of that video sent automatically to you. If you've met with me in the past, but not within the last few weeks, this is a new thing. There's a new app tied to Zoom that will automatically send a link to the video of our meeting. So it's great. It works out really good. The clients have been really happy with it so far. And I think it's going to be really valuable in the future, because I always say it's really important to me that you are properly educated on these products when you get them, because Your agent could get hit by a bus the day after you start your policy. And if you don't understand how to manage your policy, or you don't remember the plan that you had, you might get in trouble. We don't want to see that happen. So it's nice when we have video to record this stuff and you can refer back to it. If you're an agent, check it out. It's called Fathom Note Taker. It's part of Zoom, and it'll automatically send a link to your clients. So my clients have been very happy with it. I bet yours would as well. It's free also with Zoom. So like there is an option that I could have paid Zoom to have Zoom recordings hosted on Zoom's site, but it was really expensive. And I meet with people like every day. So the amount of space that I would have needed to be able to do that was just, it was really cost prohibitive to be able to offer that. So I always just downloaded it locally. And if somebody wanted a copy of that, then I would have to do it as a private video, and get that to them. Now we don't have to worry about that. You have to have the link to be able to see the video. So only your client's going to get it, because they're going to get sent that link, and they should have the option to download it there too. So pretty cool. Hopefully you guys found this of value today. We'll be back Thursday. And if you're watching this afterwards, put your questions in the comments section. Join us on our next live stream. Tuesday's IUL, Thursday's Whole Life, and we'll be back again.
I had a chance to talk to this client a couple of days after this live stream aired, and they were thrilled at the video. They did say the assumptions that I had made in this were all correct. They were doing premium financing. They are paying for the first 5 years, half of the premiums, and they were very thankful to get my input. We had a good conversation about the risks to be aware of and how to manage this policy in the future so that it doesn't get into any trouble depending on how things progress with the interest rate environment, if caps are low, and where the loan rates end up being at. So there were some things that we were able to discuss that helped them even more beyond what you saw in this video. But it was nice to see that they appreciated what we did here, and they were able to confirm that the assumptions that I was making based on what we saw in this illustration were all spot on. Now, if you have an illustration that you would like us to review, or you have a policy you would like me to review, be sure to send that in. I'm happy to look at it for you. We can do it as a live stream, or we can just do it one-on-one. You can sign up for a private consultation using my Calendly link.
Hope you found value in today's video. If you'd like to find out more about IUL and the Whole Life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.